Welcome and thank Tom Mangan for being here, and I'm going to more or less hand over to him for today's session, which is all about planning your financial future. So hopefully everybody's got pens and paper ready, including me, because it applies to everyone no matter how old you are. So Tom, over to you.
Already mentioned the two things that you're going to need is a pencil or a pen. Make sure you've got at least a few pieces of paper, probably 3 or 4 A4 sheets of paper, and that's all you need really for today's webinar. So hopefully make it as interactive as possible. So just a little bit about me before we get started. You're probably thinking, who the hell is this guy in a board office? Well, first of all, that's a fake background. So I'm actually at home, just like most of you guys, but that is my office in Nottingham. I live in Leicester as well, just like you guys. I think most of you are from around the Colville area, I'm not sure. So just a bit about me. So my background was in football. So when I was a young lad, between the ages of 10 and about 18, I played football at quite a high level. So I played for Aston Villa for 7 years. And I wasn't quite good enough to get a pro contract. So I went into education. I went to university, got my degree, and finally got a master's degree as well. At the same time, I became a personal trainer and developed a personal training business. At which point, I didn't quite know what to do with my money. My parents were going through a bit of a hard time as well, so they didn't quite know what to do with their money, and they wanted to make sure they were okay in retirement. So we spoke to a financial advisor, and that financial advisor gave me lots of ideas at a young age for me to sort of develop my own sort of wealth and make sure that I'm safe and secure for the rest of my life, really, and to help my parents out as well. And I enjoyed that, and I thought that was so valuable that I thought that's exactly what I want to do for other people, which, you know, over the years has brought me to today. So I completely left my job as a personal trainer, came out of the business completely. I applied to become a financial advisor. I got all of my qualifications over a number of years. I opened my own financial advice practice, which is Tom Mangan Wealth Management, which you can see there. And I then applied to become a partner of a company called St. James's Place, which is the logo that you can see there. So just a little bit about St. James's Place. They're a FTSE 100 company, so we're currently 65th. Now, if you're not sure what the FTSE 100 company is, or what the FTSE 100 is, don't worry, because I didn't have a clue what it was at your age either. The FTSE 100 is the biggest 100 companies in the country. So we're currently sat at 65th, and we manage money for people. That's, in simple terms, that's what we do. So we have over 143.8 billion pounds worth of clients' funds under management. So I was lucky enough to be partnered with this massive wealth management company. And what do I do now? So I'm a financial advisor. I have my own practice. And essentially what I do is I look at what people want in the future. So, for example, do you want to retire as young as possible? Do you want a house in 10 years' time? Do you want to make sure that you're going to be okay if you can't get to work? I look at all of these different things, find out what's important for the client, and basically look at where they want to be in the future, look at where they are now, and I put the strategy in place to get them where they want to be. So more specifically, I look at products such as pensions, investments, mortgages, ISAs, you name it. I can help the client put it in place.
I have a question.
Oh, hello. I can't see who it is.
I'm the one who says Joseph. Is it are you guys like a robo advisor?
Oh, what? Sorry.
A robo advisor. You know, like the stock market. You kind of like look after people's money and you invest it into different stocks.
Yeah, exactly. By robo, do you mean sort of
automated kind of thing?
Yeah, so that is what I do, but I'm the complete opposite. So I'm in person, I'm talking to people. The problem with sort of automated processes, computers don't have emotions. So for example, if you felt really strongly about something for a specific reason, like I don't know, you wanted to make sure your kids in the future were okay if anything happened to you, then the computer couldn't understand that emotion. and put it into place. So I'm
right.
an actual human being. Yeah,
I'm sure.
hopefully that answers your question.
Yeah, it does. Thank you.
But in terms of what I do, that's you're exactly on the right lines there.
All right.
So yeah, that's it. It's just a good little explanation of how I work. So it's very personal. And at the end of the day, people like to speak to human beings, and that's something. If you can get a job where you are speaking and understanding emotions, then you're never going to go out of business, because people are always going to need that, even with excellent technology these days. Let me just make that a bit smaller. So, draw your financial future. So this is a webinar that I completely made up myself. I've done it a number of times, a handful of times over the last couple of years. I was never sort of trained in this. It was just an idea that I had, and I put it all together myself. It's really easy because, like I said, all you need is pen and paper. So my big thing around how do people come to making good financial decisions and being financially okay for themselves? Well, for me, the biggest thing is education. If you can be educated, and you make better decisions in the future. And what's the best way to educate? Personally, I'm a visual learner. So everything I do with my clients, when I was doing my exams, everything I did was drawing things out so I could see it. And I would imagine a number of you guys are the same. So if you draw something down and you write down a plan, you're much more likely to achieve it. And there's just a few notes on there. So just a few facts, people retain 80% of what they see, because they can form associations and they can understand the information better. Whereas 20% of what people read, they actually take on board, and only 10% of what they hear. So if we're drawing and you're listening, then 80 plus 10%, you should retain 90% of this webinar, and which is unlikely, but it gives you a better idea. So this is all about educating yourselves. It's about drawing out what you want your financial future to look like. We're also going to look at what it's looked like in the past. You don't have to share this with anybody, so it's really personal and private to you. You can just write this down and keep it yourself, but at the end of the day, you're writing down a plan, and you're much more likely to keep to it if you write down a plan. So all the way through, I want you to just draw with me. We're going to draw out a life plan, which I want you to keep coming back to and referring to. There's a little bit of writing at the start, but it'll all make sense as we go through. So what I'm going to do is attempt to switch over to my iPad. Hopefully this goes smoothly. If I can get rid of that. And I'll start to share my iPad screen. Bear with me 1 second. I just want you to let me know as soon as you can see my iPad. Yeah.
Yeah, I can see it.
Yeah, you can see it. Good. Let me just minimize that, make you guys a little bit bigger. Okay, so has anybody not got pen and paper with them, or pencil and paper? Give me a shout now and I'll give you a few seconds to grab one. No, we're all good. Okay, so the first thing that I want you to do is just write down these words. I want you to write down, and I'm going to do it with you. What matters, and excuse my handwriting, it's not my strong point. What matters about money to me? And I just want you to spend a minute thinking about it and writing it down underneath. What matters about money to you? And I'm just going to give you a minute. I'm just going to write down 1 or 2 points, maybe if you're struggling for ideas. Okay, that's over a minute, so you should have something down. And just a few ideas there. I don't want to put words into your head, but this is very personal to you. So I've put, if you can't understand my handwriting, again, I'll apologise. Having enough month to month, having more than I could ever need, or something as specific as I want to buy a house. So some of you guys might be thinking, I just want to be able to live. Some of you guys might be thinking, I want, you know, enough money to look after myself, my family, or I want more money than I can ever need. And it tends to be somewhere on that spectrum. Hopefully you've all got an answer down. Now, the next thing I want you to write is what really matters. And now what I mean by this is I want you to start thinking about feelings. So what you've just wrote above that, what really matters to you. So for example, if by me having enough money month to month, I feel secure, I feel safe, or I want to start a family and I want them to feel secure. Or is it this side of things? I want more money than I can ever need. It makes me feel like I've achieved something. So just have a think what really matters to you, and I want you to start to think about your emotions and what it's going to make you feel like. I'll give you 30 seconds on this one. Okay, that's 30 seconds. And then the final thing I want you to write down is why. Why does it matter? And why does it really matter? Why do you want to feel that? What's it going to do for you? Okay, give you 10 more seconds. Make sure you've got an answer down. And don't forget, I'm not going to ask you to share this. This is personal for you, and you can look back at this in a year's time. So, for example, I might put to ensure my family are okay, or I don't like living at home. Okay, again, very personal to you. Now I want you to get a decent space, a decent amount of paper. And the next thing I want you to do is think about how old you are today and think about how old you're going to be in 20 years time. And I want you to draw what you want your life to look like in 20 years time. Some of the older people on the call are thinking, I can see some smiles there. So that's what I want you to do. I want you to draw it out. So for example, if, I don't know, going back to the family, I might draw my house. It doesn't have to be perfect. I might draw my house there. I might want a dog. That looks a lot more like a cat, but I might want a dog. I might want 2 children. Or I might want a speedboat. It can be something as materialistic as that. And again, excuse my drawing. It looks more like a shoe, but that's actually a speedboat, believe it or not. I just want you to spend, I'm gonna give you another minute and a half just to draw, and you can draw as many things as you like on there, but I want you to draw what it looks like for you in 20 years time, what your life looks like. That's a rocket ship. Okay, I'm going to give you 30 seconds, 30 more seconds, just to make sure you've drawn as much as you can. Okay, good stuff. Anybody feel confident enough to let us see what they've drawn? I said I wouldn't ask, but you don't have to. Anybody feel confident enough to take yourself off mute because I can't see everybody? Jenny,
Absolutely.
I can see you.
Yes.
Yeah, do you want to hold it up to the screen? You want to talk us through it? What have we got there?
This is my cottage and this is my farm.
Can you just share your screen, Tom?
Yeah. Oh, kind of. Yeah. There we go.
Sorry, Jenny. Go again.
This is my cottage and this is my farm, but I also want a cattery as well.
A cattery. I was going to say, are they cats on your farm, or what kind of animals have you got?
That's supposed to be a pig.
Ah, pig. Of course it is. It's because it's small on Zoom, obviously, not because of the drawing. Very good, very good. Anybody else want to share what they've drawn?
I don't mind sharing this. It's a bit scruffy.
Yeah.
I don't know.
Well, can't be scruffier than mine.
How do you?
Just hold it up to the camera.
We're speaking anyway. I don't know. Can anybody see that?
Yeah, just about, yeah.
We can't see it in this room, but it's basically a house full of sculptures and a really nice place to chill and relax. And I've got the 3 windows with my 3 kids, and they're all in their own places, doing okay for themselves and happy.
Very nice.
So I haven't quite got to the work bit yet.
Very nice. So what you should start to be thinking about is, if that's what I want in 20 years time, how am I going to get there? What's important for me to do? So you might be thinking, okay, maybe I want to give some cash to my kids. So how am I going to start doing that? What kind of job do I need? What kind of income do I need? You might be thinking, how am I going to afford my cottage with my pigs? Do I need to get a mortgage? What does my job need to be to get the mortgage that I want to get? So it's just, I mean, you're not going to put a plan in place now, but you just start to provoke some thoughts, and hopefully even give yourself a bit of motivation to do well, and, you know, crack on with your careers. Okay, so let me share my screen again. Where are we? Go back onto my iPad. Let me know when you can see it.
Yep.
And then we've got this isn't personal to me, by the way. I don't expect to have a rocket ship in 20 years time, but you can be either really materialistic and want lots of big things, which is completely fine, or you can just want to, you know, just about get by from week to week. It's fine as well. And then there's everything in between. Okay, so what we're going to do next is start to draw out what your life will look like financially. So what we've just done there are soft facts, things, emotions that you want to achieve. So now we're going to go to sort of the harder facts and the actual numbers and the finances, which is sort of the role that I have to put in place for people. So I just want you to copy this. So I want you to draw a line there. I want you to draw basically a big H. Or if anybody's into rugby, you'll know what that is. And then I want you to draw 2 lines. So 1/3 of the way along and 1 2/3 of the way along. I want you to put a 0 here and 100 there. And just while you're catching up and drawing that out, does anybody know? Anybody hazard a guess at what that might be?
Is that like a scrumming thing? Because in rugby, like they have that scrum thing, don't they?
It looks like one. It could be. It could be. But if we think about financially, then we're talking about life planning. We remember what this webinar is about. 0 to 100. What do you think that might be?
Is this like stages of finance? Kind of like
Almost.
you go 10%, then you go 50, then you go.
It's almost, but if we think even more simple than that, draw your financial future. What could that be? So I'll give you a clue. 50% of people born today will reach the age 100. Any idea?
No.
I'll let you know. It's a life. It's basically your life. So from 0,
Okay.
Well done, Kirsty.
from 0 here to 100, and I'm not predicting anybody's lifespan. That is just the average.
Dude, if
sort
I
of
can
life.
make it to 100, that's solid. I'm
That'd be
solid.
good. You'll be happy with that.
Yeah, I'm happy with that. Triple digits.
I'm not here to make any promises, but like I said, people are living longer. So you, on average, we will live older than our parents, and our kids will live longer than us, because health is getting better. You know, vaccines are getting better, lifestyles are getting healthier, people are living longer, and it's going to continue for some time to come. So if we start at 0 and work our way through to 100, where do you think you guys might be? So obviously you're going to know where you are in terms of age, but this first line here is working age. Working age. So I just want you to label that there. And I think most of you guys are around that line. So just label that for me. And I want you to label this retirement. And then I just want you to put an X where you think you are. So maybe you're just about to get your first job and you're there. Or maybe you've already got your first job and you're here. So just put yourself on that line there. I'm going to put myself at working age, just for an example. So the next thing I want you to do is draw out what it's looked like for you. And again, this is very personal. So feel free to, if you've sat next to someone, feel free to sort of put your hand over. And I want you to draw what life does look like for you. So if I told you all of this down here is minus figures. So if you're in debt, you might be down here. If you've got some savings and no debt, then you might be up here. So let me give you an example. So I was born and my parents put a little bit of savings into a bank account for me. So this is what it looked like for me. Then they stopped when I got to age 10 and it plateaued out. And then I went to university. So I went into debt. And then I got a job and started to pay it back off. Okay, so you may have been in debt all your life, you may have some savings, you may have nothing, at which point it will just be a straight line. So I just want you to draw a line for yourself of what it has looked like up to this point. I'll just give you 30 seconds or so to do so. And if you don't understand, just let me know. Give me a shout. Okay. And the next thing I want you to do is draw what you would want it to look like in the future. And we'll come back and chop and change this as you get some new ideas through the webinar. But I'll give you an example. So I was working there to sort of pay my student loan off, and then I got a mortgage. And a mortgage is basically borrowing money from the banks to buy a house. So I went further into debt and then started to pay it off. I expect to have paid it off well before retirement. And then I really want to build my wealth up there through to retirement. I want to retire at the age of 55 and then live off my savings as they will start to slowly go down. So I just want you to draw out what you want your future to look like. And again, nobody knows what it's going to look like, but you're just putting pen to paper, drawing a plan. Give 10 more seconds to do that. And you're thinking about those things that we did earlier. So you're thinking about what matters to me, what do I want it to look like in the future. And we'll keep coming back to this chart or graph. Okay, everybody sorted? Give me a shout if not. Good stuff, I think we're about there. Okay, so now what we're going to do is start from the age of 0 and draw out what the ideal lifestyle would look like. So, for example, at the age of 0, what could we be doing to give ourselves, I know you can't do anything at the age of 0, but if you had kids and they were at the age of 0, what could we be doing to give them a good start in life? When we get to retirement, what might we be thinking about then, for example? So we'll start off at the age of 0 here. So if you've just had a child, what ideally could you be doing to give them a good start in life? Any ideas? Any ideas? Let me open it up.
Yeah, I'm going to start a trust or an account for them to start saving so they've got like an education bank already.
Yeah, exactly. So again, this comes back to what's important to you. Something that might be important to you is for your child to go to university. So you may look to start saving, and then we can start to think about products once we know that. So that's a good shout. Anything else? I think that's pretty much summarizes everything. Anything else?
Get them thinking about it themselves. Obviously not when they're 0, but right from the
Not when
beginning.
they're 0.
But a
Yeah,
little bit
you can
after
start
0.
to educate them. Yeah, so the tools that you pick up today, you can start to tell younger people, you can start to tell older people and spread the word a little bit. So, but you're quite right, you hit the nail on the head from the very start. So you might start to look to put money into an account for them. Now, you could put money into a bank account, but which is a good idea. But the problem with putting money into a bank account is that your money is in cash. And if you have your money in cash at the minute, the rate of inflation, which is the rate at which things that you buy are going up, the cost of living is going up. Interest rates are so low in the banks at the minute that in 10 years' time, your money is actually going to depreciate in value. So, for example, if you had £10 today And I'll tell you a good example. Does everybody know what a Freddo Frog is? A little chocolate bar? Yeah. How many Freddo Frogs do you think you could buy with £10? Just have a guess.
Probably like four or five. Well, maybe 4 or 5.
Let's say you can buy 5 Freddo Frogs with £10. I think I'd say it's probably a little bit more, but let's just say you could buy 5 Freddo Frogs with £10. In 10 years' time, that £10 will probably only be able to buy 3 Freddo Frogs, because the cost of living is going up, and it's not just in Freddo Frogs; it's in everything. So the prices of houses go up, the prices of your t-shirts that you've got on today will go up and be more expensive over time. At the same time, your money isn't going up in value by very much at all, because the interest rate of banks are so low. So what we might look to do is invest into a stocks and shares account. So who knows what investing is? Any ideas?
I have a little bit. I know a little bit.
Go for it.
Yeah, I mean, obviously, if you keep money in like you said, in a bank, you're just going to lose value over time, because it's just sitting money waiting to lose value.
Exactly.
So the best option you've got is to invest it into pure stocks, depending on what you want to invest in, obviously.
Yeah, so the reason we might look to invest is you're not keeping money in cash, but you're putting money into something that is going to go up in value and is going to keep pace with everything else in the world. So for example, your parents or you will probably know somebody that owns a house. Now, houses over the last 20 years have done really well in keeping pace with the rise in the cost of living. So that is investing into property. You may look to put your money into the stock market, for example. And if it's in a good investment, then that money is going to grow at a quicker rate than the cash would in the bank. Now, it has to be a good investment, and that's when an advisor like myself would come in. But you could do that for somebody who's just been born. So you might put your money into what's called a junior ISA, and that can be invested in stocks and shares, which means money that you put into that account at the age of 0 for a newborn baby is much more likely to keep pace and keep its value all the way through to the age of 17, 18 when they go to university. Okay, so let's just draw that out for you. Now you know what investing is and why you might do it. This is what it might look like. So if you put £10 into the stock market, then it might grow by, let's just say, 10% in a year. This is just an example. So you've put £10 in, it might grow by 10%. So there's the 10% growth. Now, how much have you got? Can anybody tell me how much you've got now? Anybody?
£11.
£11, easy. So you've now got £11. Now, the next year, if it grows by 10% again, don't forget you've only put £10 in. So you've only put, let's just say you've only put £10 in. You are now gaining interest on the interest. You're gaining interest on the interest that you earned last year. So now you're gaining 10% on top of £11 instead of £10. So this tends to snowball really quickly. So if you can put money into an investment for a 0-year-old, for example, then that's called compound interest, and it will grow that money at a pretty quick rate, and it will snowball up. And it only costs you £10 to do so in the first place. So that's called compound interest, and that's why it might be a good reason to invest. In terms of what you're actually putting your money into, well, we talked about having your money in cash, and it's probably not the best place at the minute to put it for because you only get a small amount of interest. So you can invest your money into cash. The good part about having cash is that it's accessible. You can take it out of your bank at any time. Like we said, the downside is that it's unlikely to keep pace with inflation. So we've already sort of spoke about the stock market. So you could put your money into stocks and shares, and that's the little arrow I'm going to use for this. Feel free to draw this out with me. Anybody else know what you might be able to invest your money into? Any ideas? Crypto? We won't go down that route.
Isn't crypto like into stocks and shares? Because you're basically doing the same thing with crypto.
Crypto is it works in the same way. It goes up and down in value.
Yeah, it's like really, yeah. Sorry.
Yeah. Personally, we don't have anything to do with crypto just yet. We see it as too much of a risk.
What about Bitcoin?
Bitcoin's the same.
Yeah.
It's all the same. Any other
It's
ideas?
like stocks, but just a lot harder to predict, isn't it?
Yeah, it's harder to predict. There's not much sort of substance behind it, so we
You can't really predict it.
No,
And
exactly.
you can buy gold.
Gold, yeah.
Gold's
So gold
good, yeah.
gold is what we call an alternative asset. So yeah, gold.
I mean, gold's better than diamond, I think, at the minute.
It can be. It goes up and down in value, as do all of them.
I know somebody who said silver's the best bet, and she's done loads of research on it. So I'll say silver, gold, those sorts of things, but also property.
Yeah, property, that was on my list. So property is a good one. And I'm not saying this is a good investment, but it's something that you can invest in. I'm not here to tell you today what to invest your money into. I'm just trying to help you understand how it works. So yeah, you might invest into property. And there's one other that I'm thinking of, that one of the kind of, we call these asset classes. Anyone want to hazard a guess? No. So the last one is called a bond. Now, a bond is also called a security because it's quite secure. And the way it works is, for example, if the government issues a bond, they call it a gilt. They might issue, as an example, a £100 bond or gilt. So what will happen is you will give the government £100. They will pay you, let's just say it's 3%. So they may pay you 3% over 10 years. And at the end of the 10 years, they'll give you your £100 back, and they will give you 3% a year until they give you that £100 back. So basically you've made 3% a year on your £100, which is higher than interest rates at the minute. So this is so when we look at investing and when we look at these different asset classes, we think about risk. Now these two are the lowest types of risk, and these two are slightly higher. But with higher risk comes higher potential reward. So if you keep your money in cash and bonds, then it's lower risk, but the chances are you're not going to achieve as much in the future. If you put your money into slightly higher risk and you've got a long time to be able to invest, then the chances are you might achieve a little bit more. But the key thing is you have a nice blend of all of these things, and we call that a portfolio. So if you've got, I don't know, 5% of your money in cash, 20% in property, 20% in stocks and shares, you can make it match what kind of risk you want to take, and that is what we call a portfolio. So it's almost like having your eggs in multiple baskets. Okay.
Tom?
Yeah.
Could I just bring in Matt, because he had a really good point to make, which I think sort of envelops around the whole of this as well.
I mean, I think you're
Yeah, go for it.
talking fiscally, but I meant you can invest in yourself as well, so like further education increases your prospective ability to earn money. Yeah.
So people will see, you know, this kind of thing as the best investment. Actually, I run my own business. I could put my money into the stock market, or I could invest my money back into myself, put myself on, you know, more education, invest it into my business. And actually, at the end of the day, with me being better at what I do, my business being better, am I going to earn more money in the future? Probably. So yeah, it's a great shout. You can invest in yourself as well.
I was thinking this morning just about something like driving lessons. So you know, wrapping around the edge of this, if you had a big circle for self and thinking about all the things that you could invest in yourself, which would enable you to better enjoy life and achieve. So things like driving lessons will open up opportunities for more jobs and making more connections.
Yeah, exactly. Before all of this, investing in yourself is the best thing to do. So we're talking now about once you're happy with where you are, and once you've got that job that you want, that you need to get that cottage that you want in the future. The only way you're going to do that is by investing into yourself. So yeah, that's a great shout. And it's almost taking a step back from, you know, purely money and thinking about, you know, how else can you invest in investing in yourself, basically. Yeah, so great shout. So the final thing I wanted to do just before we put that onto our timeline is show you an example of a product. So now you've got your investment, you've got you've got your portfolio, your stocks, shares, whatever you want. You need to pick a product to put it into. So for example, has anybody heard of an ISA?
Yep. Yes.
Yeah, can anybody tell me what an ISA is?
You just put money in it over a period of time, over a long period of time, and it gives you interest back. Like
Exactly.
usually 0.0% interest with banks nowadays.
Yep. So an ISA can be a cash ISA. So 75% of ISAs in the country are cash, or you can have a stocks and shares ISA. Now, the beauty of an ISA is it's a tax-free environment. So the money in there, if it grows, it's not taxable.
But isn't it once you get above like 20,000, you have to pay like 17% interest, like 17% tax or something like that?
So yeah, so your maximum ISA allowance for the year is £20,000. So you can put £20,000 into an ISA a year, and then when you start to earn interest on the extra money that you put in, then that does become taxable. So we only look to put £20,000 into an ISA a year maximum, and you're in a pretty privileged position if you can top that up every single year. So the way that it would work in terms of an investment, your portfolio would be here. So let's just say this is your portfolio. So you've invested your money into the right places. You put your money into an ISA. And let's just say you've managed to top it up to £20,000 for the year. Now, if that money grows, so let's just say the 10% that we spoke about earlier, so let's just say it grows by 10%, which is unlikely if it's cash, but it could well do so if it's invested into your portfolio. Then in any other bank account, that could attract tax, but this growth here is tax-free. So that's just an example of what you might look to put your money into. The reason we picked ISA is because it's a tax efficient environment, or tax, you're not going to attract tax on the money that's grown. And in relation to our actual graph that we were drawing out, you could have a junior ISA. So you could put your money into a junior ISA, which is invested in the stock market for a child. And you could do that every single year, and the money would grow. And eventually, when they get of age, it would turn into a normal ISA, and they will be set up. And hopefully, they'd have enough money in there for their education or whatever it is you started to put money into in the first place. So I want to go back to our graph here, or our lifetime, or lifeline, whatever you want to put. And I just want you to plot where you think an ISA might be a good idea to start thinking about for you. So in my sort of perfect little world here, I would have liked to have had an ISA or a junior ISA at the age of 0, but I just want you to plot when you think would be a good idea, a good time to start thinking about putting some of your money into an ISA. I'll give you 30 seconds to have a think about it and plot it in there.
I mean, I would just say working age. As soon as you start work, but probably like 10, 15, 20% of what you earn into it if you can. Yeah.
That's a good idea. We're going to do something similar to that just towards the end, but these are all very, what you come up with here will be very different to the next person, which will be very different to the next. So if you think you can start doing it as soon as you get a job, and you think that's a good idea and it's going to help you in the future, then that's when you plot it. If you think, I just want to keep investing in myself for the next 10 years and not save any money, that's up to you. You might plot it in 10 years' time. So plot it for when you feel is the right time for you. Now, another type of investment is a pension. So again, with pensions, you're just putting your money into the stock market. And if you guys have got, if you guys are employed, then the chances are soon, well, by law, soon you will be asked if you want to opt in or opt out of a pension as soon as you're earning over a certain threshold. So can anybody tell me, and these are a little bit more complicated, so don't worry if you're not completely right. Can anybody tell me what a pension is or what it does? Any ideas? Because this was pretty alien to me until a good few years older than you guys are now.
Isn't it like when you get money taken out of your paycheck and it goes into like your pension account, and then when you retire, you get all that money?
Yeah, in a nutshell.
It's usually like 5%, isn't it? Or you can give more if you want.
Yeah, exactly right. Both good points. Can anybody tell me anything else about a pension?
Yeah. So is it a portion of your paycheck, or if you join a mutual, you can use like larger buying power to accumulate a higher pool of liquid equity to then be reinvested on your behalf that can give you a higher percentage return later on in life? You just lose access to that money in the short term and you receive it later on in the long term.
Yes, that last line there was summarized it really well. So what you're doing is you're putting your money into the stock market now. Your employer is also contributing, and you're growing an amount of money which you can't take or use until you're 55 under current law. But what you're doing is basically you're saving for retirement. And you might think, well, why can't I just put that money into a savings account? Well, there's a number of perks that you get with a pension, because the government understand that people don't tend to think about retirement as much as they should do. They rely on the government, but actually the government are getting slightly overwhelmed, and it's only going to get worse. So the government make a number of sort of perks to encourage you to put money into a pension. And again, I'll draw it out for you. So let's just say this is your pension pot. Who's the pension pot with? Remind me. What provider do you guys use?
It's Nest, I think.
Nest pension. So Nest is a real common one. So let's just say this is your Nest account. Okay, this is you over here. This is the government here, and this is your employer, whoever it might be. So the company that you work for. I always draw it as a bit of a property there. So just like earlier, you're in a portfolio, so you're in a nice mix of, I don't know, it might be stocks, shares, bonds, cash, the lot. So you've got your portfolio, and you've got and that's within your pension pot. Just like ISAs, pension pots are a tax-free environment, so any growth that you get, you're not going to get taxed on. And what happens is each month, let's just say you contribute £100, and there is a minimum that you'll be able to contribute, but it depends on how much you earn. So let's just say you contribute £100. What happens is the government will give you back tax that you've paid. So in this instance, £25.
Hello, Tom. I've lost connection.
No.
Maybe his internet went down or something.
So James, oh, have we lost Tom? Oh, there he is.
He's back.
Tom, I was going to ask a question about that government £25. If you are,
Sorry, did I just drop off there?
you just dropped off. We got to the £25 going in from the government.
Yes.
If you're not paying tax because you're under the limit, does that £25 still go in?
Yes. So you're getting given tax back that you've not even paid in the first place, which is pretty astonishing.
Yeah.
Yeah. Can you see my screen?
Yes.
Yep. So let's say you earn £10,000 a year. The tax you're allowed to earn £12,500 a year without getting taxed, and then you start to pay 20% on anything you earn above. I think it's 12,570 now. Even if you earn £10,000 a year, you put money into a pension, you still get that government top up, even though you never paid tax on it in the first place. So you're getting your £100 that you put in, you're getting £25 from the government in this example, and your employer is also giving you £100. So it's cost you £100 to get £225 into your pension. There isn't many other products that you can sort of multiply your money just like that. So your money goes into your pension pot. It's invested in your portfolio, which you've chose. And hopefully it's keeping pace with inflation over the years. So it means that that £225 that goes into your pension today is worth £225 in 30, 40 years when you come to take it in that amount of time. And you can buy the same amount of Freddo frogs that you could buy today. All right, are you with me? So who thinks a pension is a good idea? Just raise your hand if you think it's a bit of a no-brainer when you put it like that. Yeah.
My dad got done on his pension. He lost all his pension. I think it's like Northern Rock or somebody else that went and then he lost like the majority.
He lost it.
Yeah, well, he still got like some payout eventually. I think another company bought the debt from the other company, and over time he managed to make sort of accrue what he put in back. But yeah, he was I think it is an unlucky one, but yeah, he lost money, I think.
Yeah, when you are setting up a pension, you need to make sure that you've got the protections in place, which means that if anything ever happens to that company, then you are fully protected. And these days they are a lot better than what they used to be, 10, 20, 30 years ago. Okay. All right, so moving on, I want you to go back to your graph there, and I want you to plot when you think a good time would be to start contributing to a pension. Again, very personal. You might not want to do it just yet. You might have already started, in which case you'll plan it. You'll put it in at an earlier date. Okay, so can anybody remember what happened here? Why am I going into debt there? Anybody want to shout out?
Mortgage.
A mortgage, correct. So we're going to run through a mortgage. So you said, I think a couple of you, I think both examples that you gave, one of you wanted a cottage in years to come, and the other one wanted their children to have their own places. So to do so, that you're almost certainly going to need a mortgage. Can anybody tell me how a mortgage works or a little bit about it at all? Feel free to just chime in. Yeah, Joe?
I mean, you borrow like a large amount of money, and then you either have two options: you pay it back with repayment, or you pay it back with interest only. The best way, if you want to do multiple properties, if you do interest only and then you pay it back in full, or that's about it really.
Yeah,
pretty simple.
Yeah, it's good. So basically, if you want a house, houses are expensive. For example, you might want a house that's £200,000, and instead of you just having to save £200,000, which would take a long time to do, you can borrow some money from the banks. Now, the banks are going to ask for a deposit, so they're going to ask for a certain amount. The very minimum at the minute is 5%, so you'll struggle to get a mortgage if you can't put down 5%. If your house is worth £200,000, you'll need £10,000 to put down as a deposit. Now, the other £190,000 you're borrowing from the bank. And let's just say your mortgage is over 35 years, which tends to be the longest mortgages tend to be these days. Let's just say £200,000, 35 years. Basically, you will pay off that mortgage over the 35 years, and the amount that you owe will go down. Okay, until in 35 years' time, hopefully you will have completely paid off your mortgage and you will own that house outright. Now, in return for lending you this money, the banks charge an interest rate. So they say, well, I'm going to let you borrow this money, but we're going to charge you for you to be able to do so. And that's where interest rates come in. So, for example, you might have, I don't know, a 1.5% interest rate, and over the years, that's going to go down until eventually, once you've paid your mortgage off, you're not going to pay any interest. So let's just say this is the interest here. So actually, over the 35 years, you will end up paying more than the £200,000, just because they've let you borrow their money. Is that a hand up? I can just about see a hand up there in the back.
Sorry.
Yeah.
So that didn't make sense to me until I seen you saw you draw that sort of that shape on the graph. So what's it when people remortgage the house? It's never been quite clear to me.
So you might agree a 35-year mortgage, yeah. Okay, and the banks will say we'll give you a 5-year fixed term. So they might say we'll give you 1.5. You will have to pay 1.5% interest for the next 5 years. Okay, at which point you can either continue. So let's just say this is 5. Oh, I just got rid of that. So let's just say this is the 5-year mark here. 5 years. You get to the end of the 5 years, and they will say, right, we're going to put you back on our standard rate now until you remortgage. So they might say 1.5%. As soon as that 5 years is over, we're going to put you on our standard rate, which is usually 3 to 4%, until you remortgage and fix in for another however many years you need to fix in. Does that make a bit more?
Yeah, thank you.
A bit more sense. Yeah. Did someone else? Was it Harry say something then, or no? No. Oh, we're all good. We're good. And the things that you might be thinking are basically, this is in terms of loans and having debt. This is quite a secure way of doing it, and the banks give you good interest rates, better than they might give you if it wasn't a loan secured against a property.
I'm pretty sure it's the freest way to get money. Like,
yeah,
in this current time.
In the grand scheme of things, interest rates are at a record low now, so it's the cheapest time probably ever to get a mortgage. So this bit of interest here, an example at the minute might be 1.5%. So you're only paying 1.5% interest. If you rewind 20-30 years ago, it might be more like 10 to 15%. So you're paying 10 to 15% extra as you would do now. So it's one of the best times to be able to do it. And the banks know that if you can't pay it off, or you stop being able to pay it off, then they can just take your property. So because your money's secured against the property, it's quite safe. However, they do still do their checks before they let you have a mortgage. It's not easy to get a mortgage. And one of the things you might think about is, how much can I borrow? As a rule of thumb, the maximum they will let you borrow is 4.5 times 4.5, sorry, not percentage, 4.5 times your salary.
Great. I have a question. It's about credit score.
Yes.
How much actual How much does credit score actually come into buying a property?
Quite a bit, because so basically you have to get what's called an agreement in principle or a decision in principle.
Yeah, through the bank and stuff.
Yeah, through the bank. So I do that for my clients, get them a decision in principle, which means if you can back up what you say in terms of what you owe, what you earn, your credit score, all those things, then they will allow you to do a full mortgage application and get the mortgage. Now, when they do the agreement in principle or when they do the full mortgage application, it can be either they will do a credit check, and if your credit score is low, then you're less likely to be accepted for that mortgage.
What's like the standard credit score that's like above like standard? Like what's like above standard that's a good credit score? Like,
well, every sort of credit score, what's the word, provider, Experian, etc., they all have their own different scales, so it'll probably differ between each one. And then again, every mortgage lender accepts different things. So some might accept a fair credit score, some might need a good credit score. So it's really hard. My advice would just be to make your credit score as good as possible, and you do that by making payments on time, not picking up any county court judgments, that kind of thing, and just making sure you stay on top of your finances.
Okay, thanks.
Can you find out your credit score?
You can now, yeah, my app gives me my
Yeah. Experian, Credit Karma is a good one. You can find out your credit score there. But yeah, you want to keep an eye on it and start to build it as well as possible if you want to get a mortgage in the future. So yeah, try to increase your credit score. So that's a mortgage. So with a mortgage comes debt, and debt isn't such a bad word. It sounds like a horrible word, but it's not so bad in the right circumstances. Now, let's just fast forward 20 years. You've got your house, you've got your, I don't know, your family, or your farm, etc., whatever you might want it to be. You've also got this debt, so you've also got £150,000 of debt. Now, if anything happens to you, what's going to happen to that debt, and what can we do about it? So I won't ask. I'll sort of tell you this one. We might start to look at putting in what we call financial protection. So financial protection, anybody know what it might be or want to tell me a little bit about it before yeah?
Sorry.
Sorry.
Is it insurance against what your debt happens to you or something?
Exactly that. It's insurance against financial risk, essentially. So for example, if you've got your house and your property and you've got £150,000 of debt, if something happened to you, you might want your family to be able to maintain the house and pay the mortgage off and just keep the property instead of having to be kicked out of it because they can't afford it. Just as an example. So this is where it gets a little bit grim. So we think about death. What happens if anything happens to me? And then what happens if something happens to me, but it isn't enough to kill me? So we start to think about illness. And these come in sort of different ways. So, for example, if something happened to me, I would want a lump sum of money to be able to pay the mortgage company to clear the debt. At the same time, if something happened to me, I might want my family to receive an income to replace the income that I was bringing to the family. So we might think about a lump sum, and we might use it to clear debt. We might use it to leave a legacy. You might have no debt, but you still want to leave your family £200,000. And then we might think, if I died, I would want somebody to receive an income, and that might be to replace the income that I was bringing to the family. So without my income, how is little Johnny, my 8-year-old kid, going to be able to afford to live a nice lifestyle and go to university, etc., etc.? So you might look at putting an insurance policy in place for those two things. And I'll tell you how it works in just a second. The other problem is, well, what if I become ill or too ill to be able to do my job? What if something happens and I can't drive my car? You know, am I going to be okay? Is my family going to be okay? And again, you might want a lump sum, and we call that critical illness cover. So, for example, let's say I was in a car crash last week. I am not able to do my job. I'm not mentally okay. I want my family to receive a lump sum so they can make changes to the house, they can make changes to the car, they can pay for the medication that I need. Little Johnny can still go to university, even though I can't work anymore. And we might look at income protection. Now, this is if I become ill and I can't get to work. So let's just say I can't work for 2 years. If I start to fast forward in my head now, if I can't work for the next 2 years, how am I going to be able to afford my mortgage payments? How am I going to put food on the table for my family? How am I going to maintain the lifestyle that I'm living now? Is it all going to spiral out of hand pretty quickly? May I even end up homeless? So we look to put an insurance policy in place that will pay your income if you're too ill to go to work. And the way it works is there is certain insurance providers. So an example would be Aviva. And what I do for my clients is I understand what they need here. And then I find the right company and the right policy for them here. With lots of different insurers. And if they set a policy up, all they do is pay a certain amount each month. And if any of these things happen that they're insured for, then that money will go to them, the right amount at the right time. And hopefully all of those horrible circumstances that we've just thought about, you will be okay. So that's essentially what financial protection is. Now, these two come hand in hand because mortgages are debts. Financial protection tends to be taken out either before or as you take a mortgage out, especially the life insurance one. Okay, so now we know a bit more about that. I want you to go back up. I want you to plot when you're going to need to get a mortgage. If you may not want a house ever, which is fine. I want you to have a good think about where your financial protection might come in. In this instance, just as an example, in this instance, we've got a mortgage and life insurance. Just as an example. So I want you to plot it for yourself. You may not know what kind of insurance you need, so just put financial protection. You may have bills to pay now, and you're probably thinking, well, if I can't work, how am I going to pay those bills? Or a lot of you might be living at home, I don't know. But just have a think about it and think where and when, or how and when am I going to get that? I'll just give you 10 seconds to get that plotted. Okay, I want you to get a fresh piece of paper, and we're going to move along the scale, and we're going to go to retirement. Retirement. Okay, we're going to go to retirement. I'm going to give you 3 minutes for you to have a think at what age you want to retire. And I want you to draw, just like we did earlier, I want you to draw what your retirement is going to look like. So I'll give you 3 minutes, and I'm going to draw what I see quite often. Okay, draw as much as you like. Still got a minute or two. Have a good think. Just think, if I was to retire tomorrow, what would I be doing? Okay, last 30 seconds. Okay. Anybody want to share what they've drawn? Any volunteers? That'll be a no. I'll share what I've drawn. So again, apologies for the drawing. This is me on a desert island. Should have drawn some waves. It's me on a desert island. I've actually got a drink in my hand there, and I'm relaxing somewhere tropical.
I reckon you soon get bored of that, Tom.
I'm trying to put that drink in.
Say that again, sorry.
I said, I reckon you soon get bored of that.
Do you think?
Yeah.
Yeah, maybe that's just 2 weeks a year. I don't know. Whatever it might be. So that's what my retirement looks like, and that's what sort of a lot of people that I come across kind of see their retirement being. In reality, you're at a very good age to be able to plan the exact retirement that you want. The earlier, the better. And what are we going to be thinking about for a good retirement? Well, we're going to be thinking about those pension pots that we talked about earlier. And I just want you to have a think about how much money are you going to need to have this retirement that you've just drawn out there. And then what I do for my clients is I start to think about how much they need to be putting away now, how much they need to be earning, how well their pension pot needs to be growing to be able to afford the lifestyle that they want. So let's just say you've got to retirement, you've got a nice big pension pot that you're ready to draw on. And let's draw out the pension pot here. Now, one of the biggest questions I get is, what are my options at retirement? What can I do? So does anybody know the age at which you take your private pension at all? Anybody? Have a guess.
Is it 65?
No, not far off.
60.
No.
67, right?
So 67 is the age currently. No, sorry, 67 will soon be the age you can take your state pension. So
right.
that's the pension that your government gives to you, which is currently just over £9,000 a year in today's terms. If you want more than that in retirement, then you will need to have been saving into your private pension or have some kind of provision to do so. So the age at which you can take your private pension, so the pension that your workplace pension or whatever it might be, is 55. So I could potentially start to take my pension at 55 and draw down on the money that I've saved up over my lifetime to fund my retirement, essentially, from year to year. So let's just say I get to 55 and let's say my pension is worth, I don't know, I've been saving really hard and my pension is worth £500,000. Now at retirement, I can take 25% of that money and not get taxed on it at all. So it will be tax free. The other 75% is taxed the same way.
Wait, I have a question. Sorry to interrupt. Could you draw 25% out like over a period of time and then not have to pay any tax?
Yeah.
Okay, that must be how most people do it then.
Yeah.
Okay.
And then the other 75% is taxed just like your income. So at the minute you're allowed to earn, I think it's £12,570, I think this year it is, without getting taxed. And then on top of that is you start to get taxed at 20%, and then 40% over a certain amount as well. So that's 75% here is treated. You just got to think about it as an employer. So it's just your employer paying you, but actually the money you've saved over your lifetime. There is other ways. Yeah, go on, sorry.
That's them taking the tax back.
If you plan it correctly, then no, because you still get £12,500 of allowance, so you still be better off. And also, if we think back to, I mean, yeah, it could be. If you think back to the compound interest as well that we spoke about at the very start, you've earned interest on that money that you've been given back over all of these years. So actually, if you think about the 25% tax-free, you think about your allowance each year, and you think about the compound interest that you have made over the years, it becomes really quite attractive. But yeah, you're quite right. If you're already earning over the threshold, then that 75%, yeah, they will take that, it will be taxed just as income. So yeah, they are in a way taking it back again from you. Okay. And that's one way of taking pensions. Okay. The other way is very similar. So in fact, it's better off drawn as a cake, this one. So let's just say this is your cake. 25% is tax-free, and 75% is taxable. And you can take a slice of that cake as big or as little as you like. You will always get 25% tax-free. You will always get 75% taxable. You can take the whole thing if you wanted. Okay, so that's a real sort of whistle-stop tour of how pensions work and how you might think about taking it. And it's a lot more complicated than that, but that's just a real sort of high level. One good thing about pensions is the money that you put into a pension is what we call outside of your estate for inheritance tax purposes. Does anybody know what the inheritance tax is at the minute, or what inheritance tax is at all? Any ideas? Or I could just tell you.
Tax on whatever you've got, like your house and your savings.
Is it 20% or?
When you die.
What was that? 10%?
20% is it?
We're guessing 20.
20%. Go up a little bit more than that.
25%.
Keep going. 35%.
40%.
40% is inheritance tax, which is basically, in a nutshell, inheritance tax if I was to die yesterday and I was worth over a certain amount, which we'll come to in a second. In fact, I might as well say it. If I was worth over £325,000, then anything that I'm worth over £325 in my estate is it could be liable to inheritance tax, which is at 40%. So let's draw it out and see what that looks like in practice. So this is me. So I have my estate can be worth £325,000. Okay. Anything on top of that. So let's just say I'm worth £400,000. So if you add up all of my property, my savings, etc., and I'm worth £400,000, then I've got that the wrong way around. 425. 325. Then 75, so take away 325, then £75,000 is liable to inheritance tax at 40%. I can't work that out in my head, but 40% of £75,000 is quite a bit. And what that means is if I was to die, then the person who is responsible for basically the executor of my estate is going to have to pay 40% inheritance tax somehow. So we'll have to pay it was about £30,000 to the government in taxes, and this is all money that I've been paying tax on and saving up for the whole of my life. So it's really quite useful if we can try to get around doing that somehow, put a strategy in place to prevent having to pay inheritance tax. Yeah, I can see a hand up again. Yeah.
There's a way to get around that you you put everything into a trust and then you put executors on the trust so that the trust can sort of be inherited by the person to avoid the tax. Is that a possibility? Or
yeah, that's a possibility. You can put money into, or basically gift money. It all gets a bit complicated there, but the idea is to get money outside of your estate so that you can keep below that amount. So if anything happens to you, then the money is already outside of your estate, and that's a whole sort of avenue that I won't go down too much today. But you're quite right, a trust is a good way to do it, which we'll come into in a second. Any money that you put into your pension is outside of your estate. So a good way to keep your estate value down is by putting that money into a pension. Again, it's another reason, it's what the government have sort of said to encourage you to save for your retirement. There is another little complication. So if I'm married, to Mrs. Mangan, then in this example, if anything happened to me, everything will transfer to her. She has her own 325,000 as well. She will just inherit my 325,000 pounds of allowance. Okay, so really, she will have 650,000 pounds of allowance when she dies. And the other thing is, if I've got a house, if I've got a residential house, so if I've got a property, I'm allowed an extra £125,000 of allowance, as is she. We can have an extra £125,000 of allowance as long as that property is a residential property, so we're living in it, and it goes down directly to our son or daughter, or sons and daughters. So just to throw a little bit of extra confusion in there. What that does mean, if we tick all of those boxes, we can have close to £1 million of allowance. Anything on top of that would start to look at putting outside of the estate into pensions, trusts, that kind of thing. And while we're on that note of trust planning, you can put your pension into trust. So let's just say you've got £500,000 of money that you want to get outside of your estate to prevent inheritance tax. So you put it into your pension, for example. Let's just say your pension's worth £500,000. What you can do is you can put it into trust. So on death, that money will go into a trust, which means it doesn't go into anybody else's estate. So if you imagine something happens to me, £500,000 of my money, of my pension, will not go to the next person, who will then be liable to inheritance tax. That money's put into a trust. I have 2 trustees looking over it at the very minimum. And what that means is my family can use that money as and when they want, but it won't go straight into their back pockets. So if you think about, if you had £500,000 gifted to you now, what would you do with it? You'd probably spend it, or you probably, I don't know, you could do anything with it. The thing is, if you give £500,000 to somebody, they got married and then divorced, then there's a potential for half of that money to leave your family. And the other thing we think about is inheritance tax, of course. So if I don't know, if if my son inherited £500,000, if he died before he could spend it, then this would be liable to inheritance tax. And because we know that's £325,000, we already know £175,000 is going to be liable to inheritance tax. So again, it's just wastage of money. So we look to put things in trust for clients as and when we can, as much as possible. And if nothing happens to that money, it will keep in that trust, and it can stay in there for years. So for example, ours will stay in there for 125 years. It can sit in that trust for before it goes into somebody's back pocket. Okay, so trusts is about giving the right amount of money into the right hands at the right time. Okay, and I just want you to think about taking your pension, think about inheritance tax planning, and think about trusts. And I would like you to plot that onto your timeline for the years to come. So I'll show you what I'm doing. You can either do your own thing, or you can look at my examples. Okay, I'll give you a minute to do your own. Okay, so hopefully you've plotted that. You can always come back to it, and this is a work in progress. So in front of you now, you should have what your life has looked like from birth, and what you want it to look like in the future, and all the little bits of planning and the potentially the products that you might think about using. Again, this is I work with my clients to decide all of these things. But that's kind of what lifestyles look like in my experience. None of them will look the same. Everybody on here will have a different looking lifeline, and it will look different in the future as well. Everybody's completely different. What I wanted to leave you with is this is all well and good, and it's for the years to come, and that you might not think you can do much with it now, but it's good to have this knowledge. I wanted to leave you with something that you can do today. Most likely, almost all of you should be able to do this today. But what I want you to do is just write income at the top, and if you don't mind writing it down, and if it's in private, you can actually put that figure in there of what your income is, if any, or what you expect to get in the future, maybe. So I will put, if you can put it monthly, then even better. Yeah, so for example, I might, let's just say I earn £1,000 a month. And I want you to draw 3 circles underneath. And I want you to put needs. wants, and savings. And the general rule of thumb, which works well for a lot of people, is 50% in needs, 30% in wants, and 20% in savings. And you can change that as and when you wish. So if it's really important for you to save money, you might increase that 20%, but then you're going to have to decrease your wants, most likely. And I just want you to just start on the needs box, and I want you to start to write some things down in the needs box that you might need to purchase through the month. So for example, needs, food. So I need to buy food. Council tax is an example for me. It may not be for a lot of you guys. Council tax, phone contract. And I just want you to spend a minute writing down those things that you need, okay? Things that you can't get out of, essentially, you need to buy each month. And I'll just give you another 30 seconds or so to do so. Okay, and once you've done that, you probably guess what's coming next. I want you to move on to the wants box. And your wants are going to change from month to month, but I want you to write down things that you might want through the month. So for example, I might want a day out to the cinema. I might want some new clothes. I might want to go out for a meal. So just spend a minute writing down those things. Okay, and then finally savings. What am I going to do with my savings? So where am I going to put it? So I might have an ISA, or I might have, I don't know, just a regular savings account. I just want you to pop that in there. And then finally, you've got to do a little bit of maths. So I've made it really easy. Let's say I earn £1,000 a month. What is 50% of £1,000? £500. So I'm going to put it above that box there. What's 30%? 300. What's 20%? £200. Give you a minute to do your calculations. Some be easier than others. And you should have a bit of a plan moving forwards. So if you're not working yet, it's not a problem. You've got a plan for when you do work, and you can just alter those numbers. If you're working now, then you can pop your income in there, and you've got a bit of a plan, and you know what's going to go where from week to week. And then really speaking, over the years, it should really start to pay off, and you can build your financial future, so to speak. That brings us to the end of the webinar. So I'm happy to take any kind of questions that you might have for me, or re-go over anything. Up to you. Can you hear me? Oh, there we go.
Yeah, I'm just going to say, first of all, thank you ever so much on behalf of everyone in the room and on the Zoom, because I think it's been absolutely brilliant. Because we've recorded it, people who aren't here can obviously watch it and go through it. These guys can do it again. And I think we're going to make it into a little bit of a session where people can actually start thinking about their finances, and we'll have resources upstairs that people can use. And Matt's going to set up a Google Doc.
That's really good, yeah.
Anybody else
Really
want to?
good,
Can you just stop sharing your screen, Tom, so we can see who else is there?
Yeah, yeah.
Cheers.
There we go.
Anybody else want to say anything?
Yeah, any questions, or anything you wanted to add, any personal experiences or whatever you want to do, then feel free. If not, then yeah, I think I've covered. I can see a hand up at the back again.
It's a bit of just a random one. You subscribe to the efficient market hypothesis?
Say that again, sorry.
Do you subscribe to the efficient market hypothesis?
Do I subscribe to it?
Do you think the markets are rational?
Oh, as in, yeah, I would, yeah, I'm leaning that way. Yeah, that is kind of the way, yeah. Go on, sorry.
Ethical investments. So if you wanted to invest, but you only wanted to invest in green energy or social enterprises or ethical things, is there a way of doing that?
Yeah, so there's more and more companies doing it, because if they're not, they're getting left behind. They are getting left behind, but also it's unethical. So yeah, I mean, I can only speak for ourselves, and all of our fund managers are signed up to the PRI, I believe. So they all have certain guidelines that they have to meet, certain criteria they have to meet, to make sure that the investments are quite, responsible. Yeah, so it's a massive thing at the minute, and they say that the investments that you hold are on average 27 times more powerful for the environment than the things that you do from day to day. So for example, if you're invested in, I don't know, a fuel company, for example, and then your portfolio is made up of a lot of different companies that aren't hitting ethical standards, then you're actually 27 times more powerful with where you put your money as opposed to what you do from day to day. So it's a really important thing for your money to be invested ethically.
Something I wanted to also mention was community share offers. So in the very near future, there will be the chance to invest in community share offers in the local area. And that's one thing that we're doing as Coval Can Community Benefit Society. We'll be saying, if we get the chance to take over something like Hermitage Leisure Centre, that will be part of an offer. So we'll get grants and social loans to be able to take it on. It will then be run enterprisingly, and anybody can buy a share in it, and that share will come with interest. And so there is another thing that people can think about, which will be buying shares, which could be as little as 50 quid, but again, a number of them, and there are lots of places over the country that are doing share offers. So we're going to be doing that for real in Colville over a number of buildings. So it'll be really good to, to be able to offer that to everybody in the room, but also, other people out there that will be interested in participating.
There we go.
I've got a question as well.
Yeah, sure.
What's your opinion on cryptocurrency? Like, do you get involved in it? Is the market too volatile? I've lost a lot of money in it, and that's why I'm asking. That's all.
No, I don't get involved with it. Our fund managers don't either. It's actually, I want to say, illegal. I think it's not. Basically, we're FCA authorized, and that isn't. So we don't go down that route. although more and more companies are looking to include it in the future, but at the minute it's not. I don't personally do it, and I know St James's Place don't either. You know what, if I had a bit of spare cash hanging around and I wanted to play around with it and it really interested me, I might do. But when I come to things like my savings for the future, absolutely not. Definitely not.
Fair enough, mate. Thank you very much.
No problem.
I have a question. What would you recommend to invest in to save, let's say, like 15, 20 years? Which are the best ones to invest in at this present time?
The thing with investing is you can't tell what's going to happen in the future. If it's performing well now, how do you know it's going to perform in the future? So the main thing is to make sure that you've got a good, well-diversified portfolio. We have our own portfolios, and that is what I put my clients into because they're constructed by experts. Yeah, so we spoke about efficient market hypothesis a minute ago, which is kind of like a theory around investing. We have the people who are, top of the game in investing doing that, and that is their only job. So there is no one best place to put it. It just makes sure it's safe and secure.
Great. Thanks.
Yeah. Okay. Anybody else?
I'm going to do a screenshot so I can do a social media post if you want to smile, Tom. Ace. Right, I just want to say thanks again. And
yeah, no problem. No problem.
Give these guys a break and then they can come back and do some budgets.
Yeah, I mean, 2 hours is a long time to be on a webinar at the best of times. So finish 15 minutes early, you can come back and do 15 minutes of budgeting and put something in place.
I thought it was really